Hello, welcome back once again. This is Seewing Yi, and today I'm going to go over the core logic case Schiller index, the latest update dated for March of 2023. Now, before I do that, I'm going to share with you first the today's mortgage news daily website to go over the very important daily, weekly fluctuations of today's mortgage rates. And here it is. According to the Mortgage News Daily, people who have excellent credit, they qualify for today's rate of 6.91% 3-year fix. Again, people with excellent credit can qualify for this. And with respect to their VA loans, 30-year fixed rate mortgage is a little bit lower, 6.58%. And also the FHA, first time home buyers, 30-year fixed rate is 6.59. And jumbo rates a little bit lower, 6.65. So having said that, here's the challenge associated with this. As you can acknowledge, respect to the 3-year fixed rate, is a little bit, it went down from yesterday because it went down 0.04% basis point, which is good because if you look at a week ago, today is May 31st, Tuesday. A week ago, the mortgage rate were 7% on 24 May, went up to 7.3. Then the following day, May 25th, went all the way up to 7.12%. At the highest level, last week, 26th of May, all the way up to 7.14%. Now, anytime a mortgage rate becomes a psychological threshold for most people, and from 6 to 7%, and from 6 down to 5%. So remember a few months ago when their mortgage rate were like 5.99%, then people thinking, wow, finally a mortgage rate of below 6%. Wow, housing frenzy and all that. Then the following day, people just got overreacted. The rate went back up to 6%. Then, yeah, so there's a very short-lived psychological advantage for buyers and sellers with 5.99% a few months ago, as reported by Mortgage News Daily. Now, for the past few months, we are hovering around mid 6%. The last weeks went all the way up to another psychological threshold of over 7%. Now it's back down to 6.91%. Some people say this is the new normal, and people need to get used to it, and they are getting used to it. And still housing are very robust, believe it or not. They are still, even at this elevated mortgage rate so far, still because of the historic low inventory levels, there are more buyers than there are available homes to sell. So again, economics 101, pent-up demand is greater than available supply. Therefore, it will continue to put upward pressure on home prices moving forward. And that's why we're continuing to see, even right now, we're continuing to see bidding wars and multiple offers. Nothing crazy like 2021, but still the demand is still pretty good. Many markets, especially the entry level homes, especially homes that are in any markets, like below the medium price homes in all the markets in the US, we are seeing quite a few transactions on homes that are well priced relative to the current market conditions, homes that are turnkey, that are fixed up in good location, they sell very quickly. As long as mortgage rate are hovering around the mid 6, we can expect to see this because locking effect of homeowners with a historical low rate mortgage are not likely to sell their home when they have 3% rate to move up to buy a more expensive home for 7% rate, which is not going to happen unless the mortgage rate falls below 6%. If that's the case, then you have more home sellers are willing to put their homes for sale. So until then, we will continue to see historical low inventory and still pent up demand. So some of you are thinking housing crash, like housing crash is canceled. Furthermore, that's what's happening, right? If home prices this year over year, month over month this year for the past 5 months has continued going up in many markets up to anywhere from 7 to 10% appreciation on median prices past 5 months. And as the mortgage rate continues to be elevated and it put even more potential buyers on the sidelines. So you think the 40-year affordability is an all-time low in terms of people qualifying to buy a home. That was last year. I have to believe it'll be a higher than before. It'll be a historic situation environment whereby more and more potential home buyers are being priced out of the home purchase market. As a result, more people renting ever before. That's bottom line, and that's the reality of the market. And nothing will change. But let's go over the short article by K. Schiller, CoreLogic, and the headline title is "Home Price Declines May Be Over." Okay, S&P Case Schiller says. Now, bear in mind, there's one reservation I have with CoreLogic Case Schiller is that they're almost like they're lagging like 2 months behind the actual date. At the date of this on my recording this video, they only go up to March. That's one issues I have with Case Schiller CoreLogic. Not only that, I'm only going to share with you data as of March of 2023 year. Furthermore, their housing composite index mainly cover the housing markets that are very volatile. So I'm gonna share with you a lot of negative news as I go through this video presentation. But so therefore their housing index CoreLogic is they do not show a gamut of entire country. Because the entire country, there are several thousand cities, there are several thousand counties. And this index by CoreLogic does not necessarily show across the board. Am I going to say this kind of data I'm going to share with you are misleading or inaccurate or whatever? I don't know. You will determine that. So I do have a reservation about it. But having said that, I'm still going to go over it because Miller is one of the main organizations that share housing market updates. Without further ado, let me spend a few more minutes on this. Again, if you have not learned anything so far in the past few years, because of this abundance of information coming out of the YouTube videos and the mainstream media, it's just that you have to go beyond the headline, okay? Because when you most people, they just read the headline. It's all negative news all the time. Doom and gloom, the world's coming to an end. And they fail to take their time to dive deeper into the article and just really what's behind the headline. And more often than not, the headline is also very misleading. So it's my job to help you decipher, to determine what is accurate, what is inaccurate. I will give you my personal perspective. Why? Because I have 30 years of real estate investing experience. That's what I do. I help real estate investors from all the country to buy turnkey, no price entry-level homes for cash flow purposes. We put 25% down payment, even with this high interest rate mortgage environment. Real estate turnkey and mom and pop investors, which I guide and consult over 20 years, they do very well. They achieve very good cash flow over time. They buy in the whole to buy turnkey property in the most affordable, most fastest growing markets in the country, mainly in the South and Southeast, Florida and Texas is a prime example. Of course, the Midwest is also doing very well. The Midwest of housing, the low price homes, real low price homes, very affordable homes are there. It's a market that most people does not talk about because it's a boring market. It's not exciting. So you don't hear much about it. But if you're a long-term investor, long-term investors, Midwest is also a very desirable to buy turnkey cash flow homes for long-term buy and hold and hope to achieve your wealth building. So that is my slight deviation from my presentation. But if you want to be a good or mom and pop, one of the mill turnkey investor, if you want to be part of it, please subscribe to my email or my website below. I'll talk about it at the end of this video. All right, so let's go on. So the key point on this headline is home price decline may be over. S&P Case-Shiller says dated March 30th, which is yesterday. Today's May 31st on the date of my recordings. I did not read the article, but I'm going over this for the first time, just like you. So the key points are nationally, home prices in March were 0.7% higher than March 2022. We're talking less than 1%. All right. There's nothing to freak out about. So what this tells me, year over year, from March 22 to March 2023, nationally, real estate is a no-go. I need to continue to emphasize that. But there's no such thing as a national real estate market, okay, in my humble opinion. So really, things haven't changed, even though we have seen some housing market fluctuations, home price reductions in the latter part of 2022. Well, that has been the headlines in the past 9 months. Home prices went down due to high sudden rise of the mortgage rate from the middle of last year to the beginning of 2022. And yet, when all said and done, naturally the home prices were less than 1% higher this year than year over year March 2022. So to me, it's just a mere dip, a mild correction. And clearly has not been any kind of housing crash at all. So all those crash bros out there, eat your heart out, you're wrong. And so your clickbait YouTube videos are hopefully, in my opinion, gonna go by the wayside. All right. Okay, let's continue. After seasonal adjustment, prices increased nationally 0.4% in March compared with February. The 10 city again, or logic keep on going back to the 10 city composite, which is very kind of limited data, in my opinion, gained 0.6% and 20 city composite rose 0.5%. See, 20 city composite is a very limited data point, but the 20 city composite core logic usually go over the western region of the US. That makes it even more very misleading because the western region of the US show more housing price volatility than the other region of the US, such as the Midwest and South and Southeast, which the housing market in these areas, in these regions, has been doing very stable over the past couple of years. And they have not seen, most of the Midwest and South and Southeast have not seen any kind of price decline, believe it or not. Most of the temporary home prices decreases were occurring in the western region of the US, which is typical Seattle, San Francisco, where I live, LA, California, Las Vegas, Austin, Texas, Phoenix, Arizona, and Boise, Idaho. So these homes are at least temporarily, these are pandemic boom and bust market, at least short-term temporary, okay? This housing market is not going to stay down forever in the western region, in my opinion. Okay, again, don't get overwhelmed by all these headlines, doom and gloom and all that stuff. So don't fall prey on all these kind of negative headlines. Anyway, that's Tennessee Composite, which includes Wiggling, like I said, LA, New York, metros, dropped 0.8%, not even 1% year over year. And then 20 city composite, which includes Dallas, Fort Worth, and Detroit. Okay, they go to the Midwest just a little bit. It's fair, a mere 1.1%. That is not going to move the needle, if you will, right? So home prices are rising again month to month. However, after seasonal adjustment, price increase naturally 0.4%, not even 1%. Just numerically, the needle are not moving that fast. because we're still seeing this this majority of homeowners that are mortgages that are have less than 4% mortgage rate, historical low mortgage rate. They're not going anywhere. So there's a lock-in effect. That's why we're seeing a historical low inventory. And this historical low inventory is going to persist for a while longer, way beyond what you think. In my opinion, this persistent historic low inventory will be around for much longer than anyone you may think. So therefore, anybody can talk about housing crash or major adjustments or flatly wrong. The housing crash has canceled, hopefully permanently. Time will tell. Acceleration of national crisis or more granular level. Here it is, some more specific. Miami, Tampa, Florida, Charlotte, North Carolina saw the highest year-over-year gains among the 20 cities in March. As you can see right here, no surprise to me because many of our investors over the years have purchased in the South and Southeast, and these cities are a reflection of the robust growth in still affordable markets in the South and Southeast. Currently and for the foreseeable future, this 40 city composite index is doing very well moving forward. So one of the most interesting aspects of our report continues to lie in the historic regional differences. That means what this means, one of the most interesting aspects of our report continues to lie in the historic regional differences. What that means is, let's say it's local. Look at Miami. Miami have continued to grow at a strong positive appreciation past 12 months, even with high mortgage rate. They have grown like almost 10% year over year in the past 12 months alone, right? In Miami and in South Florida, if you go 2,500 miles all the way to the west, the Pacific Northwest, you have seen all these price reductions in the California markets in western regions. Moving stroke is extremely local. So wherever you're located, wherever you're watching my videos, yeah, you can attest to that. So tell me where you're located. Please comment below as well to see what's going on with your market. I had to believe that you can tell me, oh, inventory is extremely low level in my market or multiple offers or whatever. Now, yeah, that's what I've been hearing. I would love to hear from you. Please comment below in terms of what's going on in your local market. Everything is local. And the final paragraph is, again, one of the most interesting aspects of our report. The core logic continues to lie in historic regional differences. The further west we look, the weaker the prices are in Seattle, minus 12.4%. Now leading San Francisco, minus 11.2% at the bottom of the league. It is unsurprising that the Southeast, plus 5.4%, remains the country's strongest region, while the West, minus 6.2%, remains the weakest. So there you go. This is local, it's the regional differences. Yeah, that's if you're interested in buying or investing in a certain region of the US, study your market, do your research, and because every neighborhood, every city, every zip code is different than another zip code, another block, another 1 mile radius, whatever. This, if you learn nothing over the past few years with this bombardment of YouTube videos and mass media showing you about housing and this and that, but everything's low. So you do your research and you will do well. So if you're a potential homeowner, I see with the rising home prices and the still elevated mortgage rates, it's getting harder and harder for the first-time home buyers to buy homes because prices are not going to come down anytime soon based on the metrics. Like I said, low historical supply inventory. For investors, a little bit different. And I consult with many of you out there over the years. I one-on-one consultation with mom and pop, turnkey investors who want to buy in affordable new markets. That's what you should do. And buy in low-cost markets in Florida and Texas, still fairly affordable. Even then, depending on specific zip code in Florida and Texas because things are quite volatile in the Austin housing market, but there are still outskirts of Austin. There's a lot of opportunities too further away from the inner core of Austin. And many of our investors are buying in those suburban outskirts of Austin. Believe it or not. So Florida, same thing. I know mining in South Florida is growing exponentially, but those homes are extremely unaffordable to many people, investors included. The median price, average price of homes in Miami is around like $700,000, $800,000 more, multi-million dollar homes everywhere in Miami and Fort Lauderdale and what have you. But the other parts of Florida are doing very well. Path of growth in the suburban markets and major metros, the various regions of Florida is also doing very well. Of course, I've consulted with many mom and pop investors to buy these markets over the years, surrounding themselves with great turnkey providers. So having said that, as I conclude this core market update, yeah, so things are becoming very positive. Prices are increasing due to inventory and pent-up demand still, the new normal. People, we're still seeing a lot of people who can still qualify for homes even at a 7% mortgage rate. So it's a new normal. People accept this type of changes, and then many buyers are understand this is it. And either now or never. So you can afford to buy a home as a primary buyer, home buyer. Who's to say you should not pull the trigger? Because waiting on the sideline, the homes will continue to increase, price yourself out more and more in the future based on the current trends. It's tough to pull the trigger for a lot of people, investors. You never a long time to buy, also hit the right market that can cash flow based on the rent to value ratio, based on the numbers, because investors you buy and hold for the long term. You don't really care about the short-term volatility as long as your tenants provide good cash flow for you. You ride out the storm, invest over time. That's how you create wealth. So that's how it is. All right. Thank you so much for listening. Please see value on this presentation. Please smash the like button and subscribe to my YouTube channel. I need a lot more subscribers. I don't do clickbait because I don't believe it's morally wrong to do any kind of clickbait crash bros videos out there. That's not my philosophy. So that's not me. All right. And also subscribe to my website below. Drop your email into the form so you become a free member of our real estate investment organization, our investment club, if you will. You can get free list information coming to your email inbox on a weekly basis on a lot of great practical information about investing in real estate. We help investors to invest out of state regardless of where you live in the country. We purchase remotely and passively using our network of experienced real estate agents in a specific markets throughout South and Southeast and West. And that's what we do. We help you to buy cash flow properties, very prudent entry-level markets, turnkey, one-stop shop, property management, everything in place. Thank you so much. This is Seewing. Thanks for listening, and I will see you on the next video shortly. Have a nice day. Bye-bye.